Do you think investing in the stock market is an exclusive club for the wealthy? You're wrong. I'm going to give you 6 tips to invest if you are on budget. Tip number 1, start small. You don't need thousands of dollars to start your journey towards financial freedom. This is a common misconception among many who are new to the world of investing. Erroneously think that a hefty initial deposit is required to start investing in stocks, bonds, or mutual funds. However, this is not the case. The reality is that with modern technology, the barriers to entry and investment have been significantly lowered. Many online platforms have emerged over the years, enabling just about anyone to start investing with as little as These platforms have revolutionized the investment landscape by offering the option to purchase fractional shares of companies. Fractional shares are essentially just what they sound like, portions or fractions of full shares. This implies you don't need to have the full price of a share to get started. Instead, you can buy a piece of a share corresponding to the amount you're comfortable investing. This feature is a game changer, especially for young or novice investors who might not have huge amounts income. It allows you to own a piece of your favorite companies, even if their stock prices seem out of reach. You can now start your investment journey with the financial equivalent of spare change. More importantly, it allows everyone to participate in the financial markets, potentially reaping the rewards of wise investing. So, don't be intimidated by the perceived high costs of investment. Remember, what's essential is not how much you start with, but rather that you start at all. This means you can own a piece of your favorite company for the price of a lunch out. Tip number 2, regularly invest. The art of investing is not just about having a large chunk of money and using it to buy stocks or other investments. It's about taking a consistent, disciplined, and approach to growing your wealth over time. Consistency, as in many aspects of life, is indeed the key in investing. Why is this so important? Well, it's simple. Regular, predictable investments help you build your portfolio over time, even when the market is unpredictable. In order to cultivate this habit, you might want to consider setting up automatic contributions to your investment account. This could be weekly, bi-weekly, or even monthly, depending on your personal financial situation. The amount doesn't have to be extravagant. Even modest amounts can accrue significant returns over time. This strategy of consistently contributing a fixed amount to your investment accounts, whether the market is high or low, is known as dollar cost averaging. Dollar cost averaging is a simple yet powerful investment strategy that can help you significantly in the long run. The idea here is that by making regular investments, you lessen the risk of making a large investment at an inopportune time. This technique used to acquire more shares when prices are low and fewer when they are high, effectively smoothing out the volatility of the market. By applying this strategy, you ensure that you keep investing, regardless of the market conditions. This strategy, known as dollar cost averaging, can help you smooth out the highs and lows of the market. Transitioning now to our third piece of advice, diversify your portfolio. This is the financial equivalent of the age-old wisdom of not putting all your eggs in a single basket. It's a strategy that's as old as investing itself, yet it's just as relevant today as it ever was. Why, you may ask? Well, let's take a closer look. By spreading your investments across a range of assets, you're effectively diluting risk associated with each one. Think of it as a safety net, catching you when one or more of your investments start to falter. You may have stocks, bonds, real estate, and perhaps even commodities in your portfolio. Each of these asset categories behaves differently under market conditions. Some may slump, while others may surge. This is the beauty of diversifying your investments. It doesn't entirely remove the risk, but it certainly spreads it out. And here's an important point to remember. Diversification isn't about chasing the highest returns. It's about balancing potential rewards with reasonable risk. It requires both a broad perspective and an understanding of your own financial goals. So, diversification, in its essence, is your portfolio shield against unforeseen market downturns. It allows you to navigate through the lows whilst capitalizing on the highs. It's the method of ensuring that if one investment performs poorly, others may perform well enough to offset the disappointing one. It's net, allowing you to take calculated risks while minimizing potential losses. In summary, if you're looking for a way to balance risk and reward, diversifying your portfolio might be the strategy for you. This means if one investment performs poorly, others might do well and offset the loss. Tip number 4, use a robo-advisor. Known as a revolutionary innovation in the world of finance, these digital platforms are designed with the intent to simplify the complex world of investing. Gone are the days when you needed a degree in finance in-depth understanding of the stock market to build an impressive portfolio. Their primary function is to offer a convenient tool for investors, especially those who are just starting their journeys in the financial market. These robo-advisors are automated investment services powered by algorithms to build and actively manage your investment portfolio. They are centered around modern portfolio theory concepts and use algorithms to find the perfect investment strategy tailored to specific needs. Their guidance is based on a multitude of factors, including your financial goals, risk tolerance, and the current economic environment. The most significant benefit is that they can be a cost-effective option for novice investors. Traditionally, professional wealth management services require a significant investment fee. However, robo-advisors typically operate with a lower cost, making them an appealing choice for beginners with a smaller investment. Moreover, they provide around-the-clock services, optimizing your portfolio even while you sleep. In conclusion, robo-advisors are effectively democratizing the world of investing, making it accessible to virtually anyone with an internet connection. They base recommendations on your financial goals and risk tolerance, and can be a cost-effective option for novice investors. Tip number 5, think long-term. Delving into the world of investing isn't to be perceived as a quick scheme to amass wealth instantly. Rather, it's a methodical process that involves building and nurturing your financial resources over an extended period. This means, one, approach investing with a long-term outlook, setting achievable goals and expectations. It's crucial not to become disheartened or when the market fluctuates, as it inevitably will. Market instability is simply part of the investing journey. It's important to understand that the world of investment is filled with ups and downs, peaks and troughs. These fluctuations should not deter you, instead should be considered as part of the process. Remember, it's about the journey, not the destination. Always keep your eyes on the long-term vision and stay committed to your financial journey. And finally, we arrive at tip number 6, continual learning. This concept implies not just an acceptance of change, but a proactive pursuit of knowledge. The cosmopolitan realm of investments is a fluctuating one, forever adapting and evolving itself with the changing tides of global economies and markets. Dynamic nature is what makes it so thrilling, but also so challenging. Continual learning, therefore, becomes a tool of empowerment in this world, a guiding beacon cutting through the dense fog of the financial universe. It's essential, an unspoken requirement, to stay updated, to dive headfirst into the ocean of information that is readily available at our fingertips in the modern world. You must endeavor to read insightful books that provide a thorough understanding of financial principles and strategies. Actively follow the pulse of financial news to keep abreast of market trends and changes. Consider enrolling yourself in educational programs or investment courses to gain a deeper understanding of your knowledge. In the fast-paced world of finance, knowledge is power, and continual learning is the key to unlocking this power. Always remember, this relentless pursuit of knowledge differentiates a good investor from a great one. So, equip yourself with the armor of knowledge. Stay hungry for learning, stay curious, stay informed, and consider taking investment courses to enhance your knowledge. And there you have it, the 6 tips to invest in the stock market if you are low on budget. If you found this video helpful, don't forget to like, share, and subscribe for more valuable insights. Thanks for watching, and until next time, keep hustling and dreaming big.